Welcome to the Deep Dive, where we crack open earnings calls, sift through the data, and deliver the insights that, well, actually matter. Today, we're plunging into Unum Group's second quarter 2025 earnings. Now, this call hit the wire pre-market on July 30th, 2025. That gave investors, just a couple of frantic hours to digest everything before the market opened. And, what was fascinating was the immediate market reaction. It was a really clear signal of caution. Made you wonder what investors were seeing there.
Oh, yeah, that rapid response tells you quite a bit about how complex these results were perceived. You saw shares take a pretty significant dip from where they were pre-call.
Yeah.
And the trading volume, it absolutely spiked.
Huge volume.
Huge. It was clear investors were voting with their feet, and we even saw options activity skew notably bearish around a key strike price. That signals expectations of, maybe further downside.
So, okay, let's unpack those headline financials because they really were a bit of a mixed bag, weren't they? Unum reported GAAP EPS of $1.92. That was down 6% year over year. But then the non-GAAP number, EPS came in at $2.07. Now, that significantly missed the street consensus. Consensus was $2.22, so they missed by $2.14. A 6.3% shortfall.
Yeah, a noticeable miss on the bottom line. But like you said, the top line told a different story. Revenue was actually a bright spot, totaled $3.36 billion. That beat the consensus of $3.33 billion by a neat $30 million. And it showed a solid 3.9% year-over-year increase. So growth on the top.
Right. And there were other positives in there, too, on the metric side.
Absolutely. The revenue side offered some counterpoints to that earnings miss. Premium income grew a strong 4.6% year-over-year. Their adjusted operating return on equity, ROE, stood at a, pretty robust 20.9%.
Yeah, that's a strong number for an insurer.
It really is. Anything over, say, 12, 15% is generally considered strong, so 20.9% really highlights their efficiency in generating profit from shareholder equity. Plus, the company maintains strong holding company liquidity, $2 billion there, and an impressive risk-based capital, or RBC, ratio of about 485%.
Okay, so a healthy balance sheet, strong capital. But clearly, that earnings miss overshadowed those strengths for the market, given the reaction.
Exactly. The narrative got shaped by the miss and the guidance.
Okay, so the raw numbers tell one story. Strong revenue and capital, but a clear earnings miss. What did management have to say? How did they frame it, especially the parts that disappointed?
Well, the CEO, Rick McKenney, he opened his remarks by acknowledging, that earnings didn't hit expectations, but he quickly pivoted, trying to emphasize that core fundamentals remained solid and that they'd made meaningful progress against strategic priorities. Standard stuff, maybe.
Trying to reassure, yeah.
Right. But the critical piece of news, the thing that really grabbed everyone's attention, was the updated guidance. The CFO, Steve Zabel, he cut the full year 2025 adjusted EPS view down to approximately $8.50.
Wow, okay.
Which is a noticeable reduction from their prior guidance. They were saying greater than or equal to $9 before. They mainly blamed higher disability claims and long-term care LTC reserve headwinds.
That's a pretty significant revision, dropping the outlook by about 50 cents. That definitely explains the market's strong reaction. But let's look at the operations. You mentioned strong premium growth. How exactly did they pull that off?
Yeah, the premium growth was a real positive. Across their core U.S., Colonial Life, and international segments, it showed a healthy 4.6% increase overall. A key factor here, they said, was unexpectedly strong persistency. Basically, clients stuck around longer than anticipated.
Retention.
Exactly. And that largely mitigated some slower sales they saw in the first half of the year. Management even highlighted the impact of their digital tools, specifically their HR Connect platform. They found that client cases using this platform saw several points higher persistency compared to those not using it. So that's a clear win for client retention through tech.
Interesting.
But despite that good retention, they're still expecting full-year core operation sales to be relatively flat, which kind of implies that new business acquisition is still a bit of a challenge, even if they're holding on to existing clients well.
Okay, so good retention, but new sales are maybe lagging a bit. Let's dig into the group benefits segment. That often gives clues about broader health and economic trends. What's happening with group disability specifically?
Okay, group disability. The benefit ratio came in at 62%. Now, while this was above their internal expectations for the year, context matters. Historically, that's actually still quite a strong number.
Right, not disastrous.
Not at all. And management's maintaining their full-year expectation in the low 60s. They cited stable paid claim incidents and what they view as, reasonable pricing discipline in the market. The reasons for that higher ratio in Q2 were kind of twofold. First, lower recoveries compared to the prior year, meaning they're getting less back from third parties on claims, although recoveries are still historically decent. And second, elevated incidence. Specifically, it related to the count of claims in Q1 and the average size of claims in Q2. So a bit of both.
Got it. Volume then severity.
Exactly. But despite these pressures, the segment's ROE remains really robust, actually exceeding 25%. Still very profitable underneath.
Okay. And what about their group life and AD&D segments? Similar pressures there, or was that picture more stable?
Good question. Group life and accidental death and dismemberment, AD&D, that was a slightly different picture. Their benefit ratio was about 70%, which was basically in line with their outlook. However, it was elevated compared to last year, and the main reason for that was a higher average claim size. That can be pretty volatile quarter to quarter, admittedly, but it still hit their results this time.
Okay. Shifting gears then to their other segments, International and Colonial Life. Did those fare better this quarter? More positive momentum, maybe?
They certainly seem to. The international segment delivered solid performance. Premium growth was 10% in the UK and an impressive, 21.8% in Poland.
Wow, Poland's strong.
Yeah, really strong.
Yeah.
And persistency in both those regions was also very good, which helped drive that growth. For Colonial Life, earnings were up, mostly driven by 3.6% premium growth. They also pointed to some really positive sales momentum indicators there.
Sure.
Things like a 31% increase in agent recruitment and a 34% rise in sales from new agents.
That sounds promising for future growth.
It does. That segment seems to be on track to hit the lower end of its 5-10% sales growth target for the year. And its ROE is standing at a healthy 18.6%. Pretty consistent performer, Colonial Life.
Okay, so a lot of core business strength in those segments. But the real headwind, and let's be honest, the elephant in the room for Unum for a while now, seems to be their closed block, especially the long-term care or LTC business. This is where things get, well, interesting. And it clearly seems to be a key driver of the overall earnings miss and that guidance cut.
You're absolutely right. The adjusted operating income for the closed block saw a, frankly, dramatic decline. It fell to just $3.9 million. That's down from $24.4 million in the prior year quarter. Huge drop.
Yeah, massive.
And the primary cause, unfavorable LTC benefits experience, particularly within what they call capped cohorts. These are basically groups of older policies where Unum's maximum payout is theoretically limited. But ironically, that structure can sometimes amplify earnings volatility when really severe claims hit unexpectedly. It makes the segment less predictable.
So the cap doesn't always smooth things out.
Not necessarily, no. This quarter, the pain came from a higher average size of new claims and lower claim mortality. Basically, people on claim lived longer than expected. Incidence counts, the number of new claims, while elevated, were pretty consistent with recent experience, so it was more severity and duration this time. And as a result, the LTC net premium ratio, the NPR, shot up to 94.9%.
Almost 95%. Ouch.
Ouch is right. That's a critical figure. It means for nearly every dollar they collected in LTC premiums, they had to pay out almost 95 cents in claims. That leaves a minuscule, almost non-existent margin. Clearly signals severe profitability pressure in that block.
And their alternative investment portfolio, the one that's supposed to support these liabilities, that also played a role in the closed block performance, didn't it?
It did, yeah. It yielded 7% for the quarter.
Yeah.
That fell slightly below their 8 to 10% long-term target range. So as a result of both the claims experience and the slightly lower investment yield, the full-year closed block earnings forecast got slashed. Now expected between $90 million and $110 million. Much lower.
But there was a big strategic move here too, right? The reinsurance deal.
Yes, absolutely critical context. Unum successfully closed a massive $3.4 billion LTC reinsurance transaction with Fortitude Re. This is a huge step. It's aimed at freeing up capital and significantly reducing their tail risk exposure to this legacy LTC business, getting it off the books, essentially.
De-risking.
Big-time de-risking. And interestingly, management views the Q2 LTC claim volatility as more of an anomaly, not something they expect to continue at that level. They also pointed out that the bad experience was split across both the business they kept and the business they just ceded to Fortitude Re. And they also noted continued progress on getting rate increases approved for the remaining LTC block. They've achieved about 60% of their current reserve expectation through those rate hikes so far.
That reinsurance deal with Fortitude Re certainly sounds like a significant move. It's almost like they're trying to, I don't know, surgically remove the oldest, most unpredictable part of their business. But how much tail risk does it really remove? Are there any potential downsides or hidden costs to such a huge transaction?
That's a good way to put it, like surgical removal. It effectively offloads a big chunk of the liability, reducing their exposure to those large, infrequent, hard-to-predict LTC claims. That's the main benefit. The cost, if you want to call it that, is essentially giving up any future potential profits from that block they ceded. But honestly, for a business like Unum, which has been wrestling with this legacy LTC block for years, the certainty and the capital freedom they gain, that probably outweighs the lost potential upside.
Makes sense. And speaking of capital, you mentioned they still maintain a remarkably strong capital position, right? Even with the LTC issue.
Oh yeah, very robust. $2 billion in holding company liquidity and that strong RBC ratio around 485%.
So despite the earnings miss, they are sitting on a pile of cash. How are they planning to deploy that capital, especially now after this massive LTC deal?
Well, their capital outlook remains strong. Post the LTC reinsurance transaction closing, they anticipate year-end RBC will be between 425% and 450%, and holding company liquidity between $2 billion and $2.5 billion. Both of those are well above their long-term targets.
Still very healthy levels.
Absolutely. And in terms of deployment, they announced a 10% increase in their annual common stock dividend. That's a strong signal of confidence. And they repurchased $300 million in shares during Q2 alone. That brings the year-to-date total to $500 million. Plus, they signaled their intention to reach the top end of their $500 million to $1 billion full-year share repurchase target.
Okay, so they're leaning into buybacks pretty heavily.
Very heavily. It demonstrates a clear commitment to returning capital to shareholders using that freed-up capacity from the LTC deal.
Okay, strong capital, strategic de-risking, commitment to shareholder returns through buybacks and dividends. So why then, despite these positives, did the market react so negatively? Let's zoom out and think about the broader investor context here.
Yeah, it really comes down to expectations versus reality, doesn't it? Despite management highlighting the strong capital and the strategic progress, the market's reaction focused heavily on the earnings miss and that revised lower full-year guidance. It indicates, I think, significant investor scrutiny on the profit trajectory, and particularly on those rising claim costs.
Right.
Are they temporary or systemic?
Right, the credibility gap, maybe.
Exactly. And you saw sell-side analysts mirroring this sentiment. Firms like Truist and UBS, they trimmed their price targets, explicitly citing margin pressure as the reason. The market is clearly saying, okay, the strategy sounds good, but show us the sustained profitability.
And how does Unum's situation fit into the broader insurance industry trends right now? Are they facing unique problems, or are others seeing similar headwinds?
Well, the insurance sector as a whole, if you look at something like the CAI ETF, it has seen some softness recently, mostly due to macro volatility. Higher interest rates generally help insurers' investment yields, which is a tailwind. But the specific challenges Unum faces, like that disability claim severity and the LTC reserving complexities, those remain pretty significant industry overhangs for many players, especially those with older blocks of business, heading into the second half of 2025.
So they're not totally alone, but their mix is maybe tougher.
Possibly, yeah. Unum's strategic narrative is clearly what you might call a balance sheet first approach right now. Use that LTC reinsurance deal to free up capital for buybacks and dividends. They're actively trying to transition the story, I think, from being seen as maybe a cheap but choppy stock to becoming a sustainable mid-teens ROE compounder. That's the goal.
That sustainable mid-teens ROE compounder vision, it sounds compelling on paper, but what's the single biggest hurdle standing in Unum's way of achieving that? Is it just fixing the legacy blocks, or are there broader market dynamics that could disrupt that whole ambition?
That's a really crucial question. While the legacy LTC block has obviously been a major drag for a long time, the persistent volatility in group disability claims is also a key factor. We saw that again this quarter. For Unum to truly become that sustainable compounder, they need consistent, predictable performance across all their segments, not just the ones that are currently doing well, like International or Colonial Life.
Consistency is key.
Absolutely. And broader market dynamics.
Yeah,
things like sustained economic uncertainty or maybe a significant downturn in employment, those could definitely impact claims or new sales. That would make their path to consistent mid-teens ROE more challenging, even with their strong capital position.
So execution, consistency. What should investors be looking for as upcoming catalysts? What's going to move the needle from here, potentially?
Okay, definitely keep an eye on Unum's November Investor Day. That's coming up. That's where they're expected to unveil a refreshed capital allocation framework post-LTC deal. That could reveal how they plan to further optimize the balance sheet and deploy capital.
More details on the plan.
Exactly. The Q3 earnings call, probably late October, will also be critical. We need to see if those claims trends, particularly in disability, and the remaining LTC block have actually stabilized like management hopes. Other things to monitor. Any further share repurchase authorizations would signal continued confidence, and maybe the launch of a new digital supplemental health product they mentioned for early 2026 could be a future growth driver.
Right. And didn't the medical cost inflation question come up on the call too?
It did briefly, yeah. Management clarified that Unum's business model, because it's largely indemnity-based benefits and wage-tied disability, means it's generally not highly impacted by medical cost inflation itself, unlike, say, health insurers who pay the actual medical bills. So that specific issue isn't a major concern for them.
Okay, good clarification. Well, this has been a really comprehensive deep dive into Unum's latest earnings. Before we wrap up, we always like to get your mind spinning with a couple of wild yet plausible trade ideas, just to get you thinking. And remember, everyone, this is absolutely not financial advice, just some thought experiments based on our analysis of the call.
Absolutely. Standard disclaimer applies. Okay, here's a first idea for you. Let's call it the patient opportunist long play. The pitch is, consider accumulating Unum shares on this significant dip. Treat it as potentially an overreaction to short-term earnings volatility.
Okay, buy the dip argument.
Sort of. The rationale is, despite the miss and the guidance cut, the underlying business did show solid premium growth, high persistency, robust capital metrics, high RBC, lots of liquidity. And that strategic LTC reinsurance deal, it meaningfully reduces tail risk. It frees up capital for aggressive shareholder returns, which they're clearly doing with the buybacks and dividend hike. So for an investor with a longer time horizon, this could present an opportunity. You acquire a company committed to shareholder value, actively de-risking, and you bet on that pivot to a sustainable mid-teens ROE compounder, eventually being recognized by the market.
Betting on the strategy to win out over the short-term noise.
Exactly. It's a bet on strategic execution.
Okay. And for those maybe with a more tactical view or perhaps a more cautious stance right now, here's a second idea for you. The cautious hedger short-term play. For a more tactical short-term approach, you might consider a bearish options strategy or maybe even a pairs trade.
Okay, playing the uncertainty.
Right. The rationale here is that the guidance cut and those continued headwinds from disability claim severity and LTC reserving, well, they suggest ongoing near-term uncertainty despite management's confidence. The market's initial negative reaction clearly signals that execution is under scrutiny, as you said. So a short-term options play, maybe purchasing puts around that $70 strike, like some activity we saw at pre-call, could potentially capitalize on continued volatility or further downside if, say, Q3 earnings don't show claims stabilizing.
Or if the macro environment sours further for insurers.
Exactly. Or, alternatively, a pairs trade. You could short Unum while going long a peer that seems more stable right now. That could hedge against broader market movements while still expressing a view on Unum's specific challenges, at least until more clarity emerges from that November investor day or maybe later quarters.
Just to reiterate one more time, these are purely thought exercises, not financial recommendations. Always do your own thorough research before making any investment decisions.
Couldn't agree more. So to wrap up Unum's Q2 earnings, it was truly a quarter of mixed signals. You had strong top-line growth and some big strategic capital moves, but those were definitely overshadowed by the earnings miss and that guidance cut, driven largely by claims experience.
Yeah, and you have this core tension. Management expressed strong confidence in the company's strategic positioning, the business model, emphasizing the robust fundamentals and capital strength. But the market reaction, it clearly indicated skepticism about that near-term profit trajectory and the persistent challenges, especially in those legacy blocks.
Which leads us to a final provocative thought for you, the listener. Will Unum's aggressive capital management and these de-risking efforts ultimately lead to a re-rating and a smoother earnings profile down the road? Or will that choppy sentiment persist as the company keeps navigating ongoing claims experience and maybe investment yield pressures? What aspects of Unum's strategy do you think will be the most decisive in shaping its future performance?
Something to mull over.
Definitely. And again, please remember that this discussion is for informational purposes only. It is not financial advice. We always encourage you to continue your own research and exploration into the themes we discussed today.
Thank you for joining us on The Deep Dive.
We look forward to connecting with you again very soon.